If you want the safest way to guarantee retirement income with zero market risk and complete predictability, a fixed annuity might be exactly what you need. Today, I am going to show you exactly how fixed annuities work, the real numbers, the guarantees, and why thousands of Texas families use them as the foundation of their retirement income plan. A fixed annuity is the simplest type of annuity. You give an insurance company a lump sum of money, let us say $100,000. The insurance company guarantees you a fixed interest rate, typically between 2 and 5% depending on the current market and how long you lock your money in. They invest your money and pay you that guaranteed rate. Your principal is 100% protected. It will never decrease due to market crashes or economic downturns. Only your interest grows, and that growth is guaranteed. The insurance company legally guarantees your principal and your interest rate. This is backed by the financial strength of the insurance company, many of which have been in business for over 100 years. When you buy a fixed annuity, you are not taking market risk like you would with stocks or mutual funds. The insurance company takes that risk, they manage the money, and they guarantee your rate regardless of what the stock market does. If the market crashes 50%, you still get your guaranteed rate. If the market goes up 100%, you still get your guaranteed rate. That is the trade-off. Let me show you real numbers. Say you invest $100,000 in a fixed annuity at 3% annual interest. Year 1, your balance grows to $103,000. Year 2, your balance grows to $106,090. Year 3, $109,273. The growth is predictable and guaranteed. No surprises, no market risk. After 10 years, your $100,000 has grown to $134,000. Then you can start taking income. Now here is where you have flexibility. You can start taking income immediately. That is called an immediate annuity. Or you can wait. That is called a deferred annuity. If you wait, you can choose to take income starting at age 65, 70, or whenever you want. The longer you wait to start taking income, the larger your monthly payment will be because your principal has grown larger. Your insurance company calculates your monthly income based on your age, your principal amount, and your chosen income period, typically your lifetime. Now, most people add what is called an income rider to their fixed annuity. This is the feature that makes fixed annuities so powerful. An income rider guarantees a specific monthly income payment for life, no matter what happens to the market or your principal. So using our $100,000 example with 3% growth, you might buy a fixed annuity with an income rider at age 62. The rider might guarantee you a specific monthly payment amount starting at age 67. When you turn 67, you get that payment every single month for the rest of your life guaranteed. Even if you live to 105, here is a real example with actual numbers. Margaret is 62 years old. She has $300,000 in savings. She is worried about running out of money if she lives a long time. She buys a fixed annuity with an income rider. The insurance company guarantees her monthly income of $1,800 starting at age 67. She waits 5 years. At 67, she receives her first income check of $1,800. Then at 68, she gets another $1,800 check. Then at 69 and 70 and 80 and 90 and beyond, every single month, $1,800 guaranteed. She never has to worry about running out of money. She cannot outlive her income. Here's what makes fixed annuities different from every other retirement strategy. Your principal never decreases due to market downturns. Margaret's $300,000 is locked in. Even if she lives to 105 and takes $100,000 in income payments, her remaining $200,000 is still protected. When she passes away, her beneficiary receives the remaining balance. Fixed annuities are not all or nothing like some risky investments. Now, interest rates on fixed annuities change based on current market conditions. When I am recording this in 2026, fixed annuity rates are in the 3 to 5% range depending on the term and the insurance company. Rates are set when you buy the annuity and they are locked in for your entire contract term, typically 5 to 10 years. After the initial term ends, you can renew at the new market rate or take your money out penalty-free if you have completed the surrender period. Fixed annuities do have surrender charges if you withdraw money before the surrender period ends, typically 5 to 10 years. The surrender charge decreases each year. If you surrender in year 1, you might pay 6% penalty, year 2, 5%, year 3, 4%. By year 6, the surrender charge is 0. But here is the key. If you plan to keep your money in the annuity until you need the income, which most retirees do, surrender charges never matter because you never trigger them. And I always make sure my clients understand the surrender period and penalty structure before they buy. Fixed annuities are perfect for people who, number 1, want guaranteed income for life they cannot outlive. Number 2, have low risk tolerance and cannot stomach market volatility. Number 3, are within 5 to 10 years of retirement and want security. Number 4, have significant savings they want to protect from market crashes. Number 5, want simplicity and predictability in their retirement income. Number 6, value peace of mind over maximum growth. Fixed annuities are not for people who need frequent access to their money or who want high growth potential. They are designed for safety and income security. Let me give you 3 real situations where fixed annuities make perfect sense. Situation 1, Jack retired with a pension and $150,000 in savings. He is 68. He wants to guarantee additional income beyond his pension so he never has to work again. He buys a fixed annuity and creates guaranteed income that covers his gap. Situation 2, Linda inherited $400,000 from her mother. She is 64. She is not confident managing investments. She buys a fixed annuity that will guarantee her income starting at 70. Situation 3. Robert and his wife are both retired. They have good Social Security but want extra security. They put $150,000 in a fixed annuity to guarantee another $1,000 monthly starting at 75. The bottom line is this: fixed annuities are the safest, most predictable way to create guaranteed lifetime income. Your principal is protected. Your interest rate is guaranteed. Your income is guaranteed. You sleep well at night knowing that no matter how long you live or what happens in the economy, your income will never stop. For many retirees, that is worth far more than chasing higher returns and risky investments. If you want to explore whether a fixed annuity makes sense for your situation, call or text me at 956-455-1313. I can run the numbers on your specific situation and show you exactly how much guaranteed income you could create. I work with fixed annuities from all the major insurance companies: MetLife, Fidelity, Nationwide, Equitable, and I find the best rates and terms for each client. And if this video was helpful, please subscribe to the channel and hit the bell so you never miss a retirement planning video. I post new content every week on annuities, Medicare, life insurance, and retirement strategy in English and in Spanish, designed specifically for Texas families. Share this video with someone who is worried about running out of money in retirement. A fixed annuity might be exactly what they need. In the next video, I am going to show you fixed index annuities, the middle ground between fixed annuities and variable annuities, giving you upside potential while still protecting your principal. I am Antonio Espino with Espino Insurance Group, and I will see you in the next video.